Indeed, Chick, a.k.a. Statman.
Hey, like
First
that.
of all, I will never, ever ask you to do a 5 a.m. segment.
Well, I would do it for you, but then you'd owe me. You'd owe me after that. Yeah, I was in New York a couple days ago, and I mean, so just because you're on TV at 5 a.m., that doesn't mean you arrive at 5 a.m. I mean, look at me.
Gosh.
I needed some serious makeup, especially that early. You know how it is. You can't sleep because it's like a plane early. You don't want to miss it. And I'm in New York. I can't miss it going to
Don't
CBC.
you
So
hate
it was a rough one, but first world problems. But yeah, I like this 8:35 Eastern time. This is much better. So thank you.
And real quick, before we get it, I know you got the stats. I know you got the deck for us. You got your T-shirt on, Facts and Feelings. I know you've been working hard on that podcast. Just I'm sure a lot of people already know about it, but if you just want to give it a quick plug, go right ahead.
Well, thank you. I'm only wearing the shirt the whole 20 minutes I'm here, so that's a plug by itself. Yeah, so Facts versus Feelings is my weekly podcast I do with Sonu Varghese on our team. He's our chief macro strategist. Comes out every Wednesday. It's we talk about all the stuff we're about to share, but it's been a lot of fun. Sonu and I think we've done like 191 or two of them, somewhere around, close enough for government work. We're inching closer to 200. Let's put it that way. So I'd love if people could check that out. But I'll get my screen here. How's everybody doing this morning? Everybody hanging in there?
We're doing good. I mean, this market, there's a lot of news, a lot of moving parts, and we love your short, medium,
see this. Let's see
and
here.
long-term perspective. He's
Yeah,
getting
let's see if I can figure
the
this out.
specs on. Are those some Warby Parker AI glasses?
Yeah, I'm getting. It's harder to see. I'm getting old. I don't know.
I can't see anything anymore.
Yeah,
I
I don't want to
on
click
and-
the wrong thing, and I don't have anything bad on this computer. It's my work computer, but nonetheless, you don't need to see the wrong stuff on here. Trust me, it's fine. All right, guys. Well, you should see that midterms. We good? We ready to roll a little bit? Yeah.
Oh, we are.
All right. Well, first off, again,
we're ready. We're giving you the stage.
Yeah, let's start talking. Again, thanks for having me back. I looked actually last time I was on was April 7th. So obviously we've had a heck of a rally since then. I shared a couple things I shared then that we were expecting a rally, and we'll just get into it. I always like to start the big picture, and I hopefully most people know me. I'm not a trader. I'm not looking for what's going to happen the next week or two. I am more of a, I say investor, but I mean, I'm a technical guy. I have a CMT. So, I look a little more tactical here, but this is more big picture. We hear all the time, and I'm still hearing it. Midterm years are bad. Yes, technically that is true. What we're sharing here, it's interesting just to note, just to be aware of. Second-term presidents have actually been pretty good. I mean, the last 6 times we've had a second-term president, midterm years have been higher. So I call it the 6th year of a president. I get it. This is not 6 years in a row, President Trump. Understand all that. But still just be aware of that. And then on the one on the top there just kind of shows how you have a decent gain, 8.5, call it 9%, and they're in the second term of a midterm year for a president, and the first term's the bad one. So that's just some context where everybody keeps saying how bad this year is going to be. And I know I came on with you guys started the year. We've been pretty bullish. For a while now. Sona and I on our team for a while. We said between 12 and 15% SP 500 target this year. Trust me, as a strategist, I hate to give targets. Our team manages about $8.2 billion. We are overweight equities. If you think about a 60-40 portfolio, we call that like a moderate portfolio. And we can kind of move that around. We're about 69% equities, so 31% other stuff, 50% US, that's 18% the other stuff. We like Developed International a little bit more than EM, although I know EM's been doing pretty well. We've got some tech exposure, so EM's turned into more of a tech play. Then the other stuff, right, 31%. In the old days, it was 60-40, 60% stocks, 40% bonds. We've been saying for a while, we're in an inflationary growth environment. We were saying that 6 months ago, people didn't really believe you could have higher inflation, higher yields, higher growth, and a good stock market. That's how we positioned our portfolios. And I've come on, you talked about that. And obviously, it's really worked out well. And we still see some of those themes. So we've had other stuff, managed futures, gold, real assets, hard assets, along with, yes, bonds. But our duration in our bonds has been shorter because, again, we thought we probably wouldn't see as many cuts as some people were expecting this time 6 months ago. Now there's no cuts coming. But the reality is that's how we positioned it. So that's a high level kind of crash course on how we see it. Just some other fun stuff, I think. We talked about the January barometer. History doesn't repeat itself. It often rhymes. Mark Twain. I like to use these historical things that when we had that 10% pullback earlier in the year, these are things we saw early in the year that said maybe it's not going to be the end of the world like they were telling us. The sweet spot. It is what it is. When January is positive, the rest of the year is usually pretty good. But when it's in the sweet spot between 0 and 2%, like we were this year, you see on the screen there, really solid returns, lower, I think the rest of the year, like only once. Yeah, only, yeah. I mean, so majority of the time higher. Just something to think about. Sell in May. I know you probably have other guests come on, so I won't say too much. And by now it's like, okay, yeah, May's gonna be up. I think May's up like 11 of the last 12 years, and July's like 12 of the last 13 years. June's up a whole bunch too. These next 6 months are technically the worst ones, yes, but lately that has not been the case at all. In last year's sell in May period, stocks gained like 22 or 23%, probably right in front of me there, for the best sell in May go away ever. We're optimistic. We're off to a pretty good start this May. This May actually has 7 all-time highs at the middle of point on the S&P. That's like the third most ever, and the only other years that had that many new highs in just the month of May were like 95, 2013, 2017. For a lot of old guys, oldsters listening to this, those rest of those years were higher the last 7 months, every time up at least double digits. Who knows if this will do that? But there's some things to think about that we're still pretty optimistic. I know we talked about this one when I joined you guys back on April 7th, because everybody, it was almost like, when's the bear market going to be? Not if there's going to be a bear market. When is the bear market back in March? Everybody was worried, and rightfully so. There were a lot of concerns. We mentioned this in. Actually, I saw my buddy Sam Stovall mention this on CNBC. So shout out to Sam. He's awesome. And I kind of dug in a little bit too. But what Sam noted, and I concluded and agreed with, usually if you move into a bear, you're down 5% in all-time highs really fast. That's what we're showing here. Sometimes it's just a couple days, like your all-time high, boom, you're down 5%. That's kind of a warning that something's a little different here, right? The 4 most dangerous words this time is different, Sir John Temple.
Mhm.
So when you see that, that's a worry. Well, this one took, where is it in front of me? 35 trading days. That's, I don't know, 6 or 7 weeks approximately, to go down 5%. This was a clue to us that we were not going to go into a bear market. We were not going to go into maybe even as much as a 15%, peak trough correction.
Too
And
slow.
sure enough, that's exactly kind of what happened. So this nailed it. We did talk about that when I joined last time. So some new stuff. Up 7 weeks in a row. Who knows? We might be up 8 weeks in a row as of right now. We'll see what happens, but we know we're up 7 in a row. But we also gained, well, what is it, 16%? Yeah, over 16%. So I found 7 other times that we're up double digits and a 7-week win streak. You can see on the screen there, 1 and 3 months later, about average returns, nothing spectacular, but a year out higher every time. Small sample size, I get it, but look at some of those returns. The last 3 times, up 20% a year after the 7-week win streak, and up at least double digits. So again, this blast of strength that we've seen off the lows, in our opinion, I've been saying it's like a broken record. It's not a short covering rally, not just an oversold rally. It's kind of the start of a new bullish phase. And I get it. This time is a little different because most of those other times you look at, these 7-week win streaks happen like after bear markets or after major corrections. This one happened pretty darn close to an all-time high. So yeah, it's not exact, but when you layer all this on top of it, we're still pretty comfortable saying we're overweight equities here. I shared this on Monday, but there are a little bit of cracks happening out there after the rally we've had. We've got an extremely stretched market, 7,500 S&P, that magic's the wrong word, that invisible 50,000 level. For whatever reason, the Dow keeps acting like trouble. Then we saw more new lows and new highs there, recently with the stock market going up. I'm not concerned about any of this stuff on the surface. I think it's more of a, hey, maybe we consolidate for a month or two. I don't think that's the end of the world. In fact, I think that'd be perfectly healthy after the rally that we've seen. We'll talk politics for a second. Yes, technically the stock market's done better under Democrats, but you know what? Republicans do a lot better than Democrats when they control the House. And when you have a split Congress, that's usually the best thing. So when you have a split Congress, we don't now, but we very well might in November. That's if everyone votes and wants their team to win. But if you're an investor, a split Congress is good. Guys, the last 13 years, we had a split Congress. Take a wild guess. The stock market went up. It's widely assumed that right now that the Republicans, not widely, but I mean, it's assumed that, the Republicans probably keep the Senate is what it's looking like. It's going to be close, but they're going to lose the House. I mean, that's don't shoot the messenger. That's probably what it's going to be. That's a split Congress. Last 13 times stocks were up under a split Congress. So just be aware. But then this is one of those big picture charts we like to share with clients. I work with financial advisors. I call it grandma. Talk to grandma a lot. Share these big picture things. Don't get too worked up on politics when it comes to investing. So I've shared this a lot, but I think it's still really important. I was talking about you guys this one a year ago, so I just keep throwing it in there. This bull market's still younger than you think, right? Bull market's like a cruise ship. Once they get moving, they keep moving. They're hard to slow down. That magic number's kind of around 3 years old, all right? Because we've had some other bull markets that, like off of COVID, but that one didn't last very long. We doubled in a couple of years, and it rolled over 2022. See you later. But once you get to that third birthday, like you see it here, right? The last 8 times, 7 of them got to at least their 4th birthday. The last 5, going back 50 years, the average was 8 years. The shortest was 5 years. I don't have a clue if this bull market's going to go 8 years. I don't think it will, but hey, I won't complain if it did. But the reality is this bull market is still maybe a tad younger than most people think. I think that's an important concept. We just doubled off the lows. It took about actually, I don't even know how long it took. I guess it's in front of us there somewhere. Well, whatever it was, well, 3.5 years, give or take, off the October 2022 lows. And then I looked at the other 7 bull markets that doubled. How long did they last after they doubled? Because what I heard a lot when we doubled a couple weeks ago was, did you know the 2007 peak rally or 2007 bull market that peaked then ended right about 100%, and it did. It's factual. But then you look at all the other ones, and the average is 3 years. Now that's skewed a little bit. Median's a little bit less. But again, just because you're up 100%, just because you're a 3.5 year bull market, that doesn't mean it has to end tomorrow. There's other things that could end it, but age does not end bull markets. I think that's important. It had to end eventually. We had a 1% drop on Friday after 8 consecutive 1% gains without a 1% drop. Just another more context to showing how incredible this rally has been in so many different ways, almost record breaking in a lot of ways. And that's what we share there. Well, here's one thing that's got my attention, I guess. Last year in in February and March, I'm not even talking about the 10% drop around Liberation Day. People kind of forget this. Most of us, including myself, including Carson Group and a lot of other places, didn't expect Liberation Day to be that big of a deal. I get it. It was, right? So why we had a 10% drop in 2 days, caught a lot of people off guard. But in February and March, the market was having 2, 3, almost a 4% drop and some big gains too. Why? Because of deep seek worries. I mean, think about that. We literally had more volatility a year ago on deep seek worries than we did right now, where we had a 6 sigma event in oil, which was supposed to happen every 4.2 billion years, and we have a war going on. We had more volatility then. So just kind of, I don't know what to make of that, other than I found that interesting. Here's a cool one. It's rare. I have a couple more here. It's rare to see the market peak around now for the year. And yes, most years kind of peak early or they peak late because usually stocks go up, 3 out of 4 years. We understand that. And like 2002, we peaked early and some other ones. But for the guts of it, once you get the middle of the year like this, if you make some new highs, it's probably not the ultimate high. We don't think it's the ultimate high as I've laid out, but just as you can see here, only twice have we peaked in May, and never has the S&P 500 peaked the month of June. So the fact we're flirting with new all-time highs, I think we're 1% away right now, but we made some last week. This is probably not the ultimate high for the year. This was a month ago. We talked about this one. I just tossed it in there. I thought it was good. We had one of the largest 10-day rallies ever. And you can see how it's usually strong. Well, we gained like another 7% after that super duper strong 10-day rally coming off of those late March lows. So just things worked kind of like you would think it would. We're right in the range of your average year. Your average year gains about 8 to 10%, right? If you invest for 30 years, you're probably gonna make 8 to 10%. Now, this is investing, not trading, but still, you know what I'm trying to get at. Only 4 times in history has the S&P gained between 8 and 10%. That's 4 of the last 76 years. So average is not so average when it comes to investing. I've shared this chart for a long time, but now that we're literally there, we're up like 8 or 9% on the S&P. We're right in the average year. Will we finish flat here? Yeah, who knows? Most of us probably agree no. And this is another reason we think it's probably a little more upside. Then a little more context to this. Your average up year gains 19%. So any random year that's higher is up 19% on average. It was not rare to have big moves. The downside is the other side, down 14%, right? So bigger swings are normal. Over the long run, you'll make 8 to 10%, but usually getting there's anything but easy. Just look at lately. 2020, right? 100-year pandemic, still gained 16%. 21, we had, what did we gain? Well over 25%. Everything's crazy. And then a bear market lost 20% in 22, 25%, 25%, and 16% last year. I'm not saying 8% anywhere in there, am I? It's like these big swings are normal, just important to remember that. And another reason we think mid-teens on the S&P and continued strength this year can happen. Just a couple more. How are people feeling? Again, I work with clients. So this is the stuff that clients are reading. Grandma's reading this stuff. I mean, just this week, check that out. Jobs apocalypse. That doesn't look very good. Then you got George Washington. I don't know if he's all hung over or what, but he's red, white, blue in the New Yorker. The AAII sentiment poll. I get it. There's flaws with the sentiment poll, but like there's virtually no more bulls the last couple weeks, even though market's hitting all-time highs. NAAIM investment managers have one of their largest drops ever, especially with stocks near all-time highs. There's pockets of optimism. There's pockets of excitement, yes. But as someone who works with clients and always tries to pay attention to what they're saying, I never get asked, wow, this is good, Ryan. How high is this going to go? There's a lot of still worry and concern out there. I do not watch the news. my job is to pay attention to the macro stuff. I was just upstairs with my wife. She's watching the Today Show. I was shocked the stuff that Today Show started with. I'm not trying to get too political, whatever. Like this, they just lead with all this bad stuff. I'm like, did they tell you manufacturing is doing well? Did they tell you the job market's coming back? Like, there's all these other things that are good out there, but it's all people hear when you watch certain news or any news. Honestly, whatever news it is, they're going to give you their spin on it. But it is what it is. So just important to note. I don't think it's nearly as bad. Now we talked about this before. We won't spend a ton of time. We were worried about inflation at the start of this year. Sonu Varghese, again, Facts versus Feelings, my buddy, we do that show together. He is amazing at the macro stuff. A lot of these macro charts I'm sharing are straight from him. And the reality, we've been seeing inflation broaden out 178 components to core PCE. That's the Fed's favorite measure of inflation. Keep this real simple. Year over year, 3% gains in that have exploded over the last, we'll call it 6 months or so. We were seeing inflation worries before the war started. All right. So, again, that's how we've constructed our portfolios for a higher inflation, higher yield world, little less bonds, but also growth. That's called inflationary growth. That's what we've expected. Now, and it's happening, So anyway, so we've seen broadening out in inflation. PPI last week up over 6%. Yeah, we're not going to get in the weeds of it, but both of those confirmed inflation's still a problem. And we'd argue it was before the war started. Now, this is wild. I don't need to get too into it, but this is PPI data showing price. You guys talked about this before I joined. This is semiconductors, all right? The reality is there's not a lot of this stuff around. Everybody's buying it. So one of the problems with inflation, the soaring semiconductor prices, the soaring chip prices, the soaring software prices, look at that going up. That's like across the board. AI components are up between 30 and 60% annualized the last 4 months. I mean, that's crazy. Now, this matters because this one pours into PCE, the Fed's favorite measure of inflation, yada, yada. But again, you've got tariffs, you've got war, you've got higher commodity prices, you've got some other potential policy stuff going on. We've got our deficits running at 6% of GDP. That's unheard of in non-wartime times. That usually means, and I probably talked to you at the start of the year, you have a pretty good economy, pretty good stock market, though. When you run big deficits, percent of GDP, that's $2 trillion that's coming into a $31 trillion economy. Where's it going to go? We've been saying it's probably going to go into the stock market. And, my job as a steward of assets is to just try to get this stuff right. I'm not saying I agree with it. I'm just saying it's to get it right. And it's working. But the flip side is higher yield and probably bond struggle. I mean, there's a yin and a yang to everything. And this is another layering on potentially higher inflation going on. Now, when I say higher inflation, let me be clear. We've said we're in a 3 to 3.5% inflation world, not 9% like in 2022 and not 2% like the Fed's target is. Again, that's what we've been expecting and targeting, and maybe even gets a little bit higher here. We'll see, but that's what we're seeing. Not a surprise, though. Everybody now all of a sudden realized inflation's hot. There were more searches on Google Trends for the word inflation than when inflation was running at 9% 2022. So this is where this gets fun and kind of hard. How much is priced in? How much is not? I mean, literally everybody on Friday when the Japanese PPI came in at 2.3% versus 0.7 expected, and Japanese yield soared and global yield soared, everyone on TV is like, wow. Did you see global yields up? And that's why we had that to 1% drop. Yields been going higher, as we know on this show, for all year, right? And even longer in a lot of cases. But the reality is a lot of this is priced in. With a 10-year yield at 4.6%, we haven't done anything yet. We're actually saying, maybe it's time to add a little bit of duration. We're not there yet. But we're talking about it from a shop that's been underweight duration, underweight bonds for 3 years. We've been saying you want to be in stocks over bonds. We still think that. We're thinking maybe there's some opportunity in fixed income coming up, but we're not quite there. A couple more. If you look at adjusted for inflation, I mean, this is one
that's a great chart.
Yeah, it is what it is. You just plug these numbers in, adjusted for inflation. Crude oil's averaged like 100 the last 20 years. Adjusted for inflation, averaged 100. Okay, that's where we are right now. So maybe crude oil. Why in the world is crude up like it is? The war is going on. Yet the stock market's at all-time highs, not just here, all around the globe. Well, maybe because adjusted for inflation, crude's not as high as it is. I'm not saying it's good, I'm not saying it's bad. It's just some context around this that really, really, I think, busts a lot of narratives that are out there. We're going to end with the consumer. Retail sales came in a week ago really strong. Yes, people are spending more at gas stations. Yes. Something called the control group, which takes out gas stations, takes out tobacco too. So I don't know, and there's something else. Anyway, but the more volatile stuff, the consumer is still pretty good. All right. Yes, AI spending the last 5 quarters has made up 45% of GDP. Real GDP has run at 2% the last 5 quarters. That's not great. It's not terrible. It's just kind of meandering a little below trend. 45% of that is AI spending. We all know that that's happening. The consumer does need to pick things up a little bit. We're optimistic they will to keep the economy going. And again, we just saw some decent data on the consumer. Now, I will say this one place we're a little bit different than a lot of places. We've been saying the labor market's in better shape this year than most people give it credit for. We think this big story the second half of this year is going to be a rebound in the labor market. Labor participation rate, prime age workers, which I believe is 24 to 55 or it's 25 to 54, one or the other, close enough for government work, is running at 80.7%, the highest level like in 25 years. Unemployment rate still 4.3%. You peel back the onion on like the JOLTS number a month ago. A big amount of people quit their jobs last month. You don't quit your job if things are going really poorly because you have a better opportunity. And then on the left there, Guy Berger does amazing work. He shared this. There are a lot of job searchers. I'm sorry, job switchers last month. Again, you don't switch your job if things are bad. All right. I switched my last job in the summer of 2022 when everybody was switching their jobs. So it's nice to see this. So again, we only need about 25,000 jobs a month to keep the unemployment rate flat. All right. We think we're going to have a little bit more than that again. And it's not the 200,000 jobs, 300,000 jobs we averaged a couple of years ago. But the truth, again, is labor market gets better. That's probably a positive thing. This is the last one. This data really makes people mad, but that's why I like to do it. The people say how bad the consumer is. Listen, credit card debt went down last quarter. If you look at all the delinquencies, which is on the left there, all the debt out there, which is, I know, $18 trillion worth of debt, 95.2% of it is paid on time. Well, you can see on the left there, yes, it was lower during times of COVID. We're just back to pre-COVID levels. Okay. So yes, there were less bankruptcies last quarter than the quarter before, less foreclosures in the quarter before. On the right, you can see actually, again, which moving into delinquent status went lower on credit cards and mortgages and things. I'm not saying things are great out there. I'm just saying when you actually look at the data, the consumer is not nearly as bad as they tell us. The labor market's probably in better shape than people tell us. And I'll stop sharing. And hopefully this is still a bull market is what we're saying. So hopefully it all made sense.
Information station here, Ryan.
I'm gonna take a
Holy
breath now. I'm gonna take a breath. Yeah.
Take a breath.
People want to know
That
if
was
you're a scuba diver.
unbelievable. What'd you say, Joel?
We were asked if you were a scuba diver or a snorkeler.
That's a good question. I don't know. Well,
What is
neither.
unbelievable?
I don't like sharks.
Like obviously, besides Ryan's, be able to talk for 20 minutes, like and just without the breath. What is unbelievable is how much you bring statistically that says we're not in that bad of shape. Because if you do watch, the competitors, we won't say them. I know you're part, but if you watch some of the other media here, and even ourselves sometimes. Bad news, like scary stuff. That's what draws people in. It's what,
Totally.
clickbait. It's really what it is. And we find, times too, we're in a war, oil prices are flying high. Inflation. I go to the grocery store. I can't afford my groceries. Job apocalypse is coming at us. I mean, that's headline stuff here. But really, when you're looking down at the stats, we're not seeing any of that here yet. No, Intuit's laying off 17%. But those people probably are software engineers that are probably getting jobs here too. I mean, us at Stock Trader Network are hiring people right now here. We need stuff like this because AI is actually going to do a lot of things for this economy. It's going to make it more efficient, but it's probably going to increase the amount of businesses that are out there too. It's going to allow us to do more stuff. So, I mean, I'm torn. I can see how AI is going to cost some jobs. But I also can see, even in our own company, how it's creating jobs here. So, I mean, does this AI, are we just getting started here? Like, what are your thoughts? Take the stats. I know it's facts versus feelings and you're full of facts. But just for, a quick question here.
Sure.
What are your thoughts on where AI takes this economy in the next 2 to 3 years?
Yeah, I mean, I think it's like a goalpost approach, right? Like the biggest companies out there that can leverage AI are going to succeed and continue to grow. That's what we're seeing with Mag 7. But the other side is smaller businesses, smaller companies like you guys. I mean, how is AI doing? It's breaking barriers and allowing you to do things that you could never imagine you could do. I mean, I don't even know if you need a marketing department anymore. I mean, you need somebody, but like you can do a lot of this stuff with AI. It's just incredible. So it's going to kind of help the two sides. I think again, the middle, like again, I work with REAs. So I'm kind of almost in a way talking about REAs here, but the small ones are going to do a lot better. But the middle ones might be the ones that kind of have to make a decision to make with AI. But the truth is, again, it's amazing. I mean, this time, what really is fascinating. Now we're going to get back to investment for a second. Remember in February, and I know people forget this stuff, but I don't. In February, people were literally selling technology, the big Mag 7, the ones that just exploded in price and the semis and all that stuff. to buy staples at 26 times earnings. They were buying the stocks that made all the money, that were the cheapest they've been in 15 years, to go buy staples at 25 and 26 times earnings back in February. And I remember in our team saying, wow, this doesn't make a lot of sense. And we've been slightly overweight tech the whole time. It wasn't fun in February and March. Trust me. Then you see where we are, but it's just the same thing. If everybody's thinking alike, somebody isn't thinking. Journal patent. We see this throughout history. Just those waves of going way too much in one thing versus the other, or vice versa. But we are still slightly overweight AI, and you just look what Nvidia just said last week and all this stuff. I mean, they're volatile. I like Dan Ives. I know people have mixed on Dan Ives. I mean, he's been very right. Like, he gets slammed when these companies go down 30 and 40%, and then they come soaring back. And it's just a lot of reasons to think it's not over yet. I know we're probably at the end here. We titled our outlook "Ride the Wave." There are a lot of waves we were getting at there. One of them, yes, was the AI wave. One of them was the fiscal policy. One of them was the earnings wave. Different waves that are out there, and a lot of these waves, guys, are still in play. But when you ride a wave, I've never surfed, but you ride a wave, you can wipe out. It's pretty spectacular. It can hurt. And we saw some of that earlier this year when we had a lot of these tech names in bear markets, and then they came back just as quickly.
Ryan, I just got one question for you, and it's amazing. I come up with questions while you're talking, and
Yep.
then you bring up your next slide, and I'm like, well, he covered that. He covered that. He
He's
covered that.
anticipating our questions.
But I'm just gonna harken back from a guest that we had earlier in the week, Blue Putnam, the chief economist here at the Stock Trader Network, and he said that this oil shift, right, has been sustained by consumers. Not looking at the XRT chart and not looking at all these retail stocks, but the consumer, right, drives the economy here.
Yep.
What I'm seeing in retail stocks here,
Yeah.
retail apocalypse, is that, well, they went to the kitty, they used their money. But now, if these higher for longer in oil is something that we're just going to have to live with,
Yeah.
can the consumer from the lower, middle, and upper end consumer, with these sustained prices of oil and all the things it affects, fertilizer and all the related products, I mean, aren't we looking at an eventual slowdown in the economy in the second half of the year?
Well, good questions there, and we could talk for 2 hours. I know I'll probably make it quick. The consumer has slowed down. Let's be clear. I mean, the consumer has slowed down when you look at consumption with GDP. I mean, that's happening. And you mentioned crude oil. Well, I mean, how's energy prices? How's everything across the board? I mean, they're all higher. So it absolutely is impacting the consumer a little bit. I'll go back to kind of where I was. I think unless the labor market cracks, it's hard to think the consumer is going to crack. And again, there are some potential positive signs. I mean, ADP has been positive for 4 months in a row, and they're seeing actually explosive jobs growth in small businesses. So small businesses are high, kind of like you guys just said. You're looking to hire, right? If small businesses are looking to hire, that's kind of the lifeblood of our economy. But the consumer is not perfect. Now, the thing is, I call this the Michael Jordan syndrome. Yeah, the Bulls don't win 6 championships with they don't have Michael Jordan. We get it. But they did because they had Michael Jordan. We do have AI. We do have AI spending. So as a person from an investments point of view, that's still a big part of the economy going forward. But I don't think anyone does, AI spending to be 45% of our GDP growth, the last 5 quarters, going forward 5 quarters. We need that to come back a little bit and need the consumer to come up a little bit. If the labor market hangs in there and gets better, I think it very well could there. Guys.
Great answer, Ryan Dietrich. Ryan, we can't thank you enough for coming on the show, sharing your statistics, sharing your facts and your feelings here on pre-market prep. And we'll be dialing you up next month. Thank you so much, Ryan.
It's always an honor. Big fan. You guys do awesome. And again, last time I was on, the market went up like 7 weeks in a row. So what can I say? I try.
Let's go.
I can't do much better than that.
Another 7 here.
Yeah, we'll try another 7. No promises. We'll try. See you guys. Take care.
Thanks,
Bye-bye.
Ryan. Awesome stuff.